Good morning and welcome to the Killik podcast for Friday the 13th of May. So this week we've had Mark Carney in the MPC talk about the implications of Brexit on the UK economy. Interesting nuance to the conversation was the prospect of a steep fall in sterling should we leave and the implications for import-led inflation coming through. So you're in a scenario where if we remain, you get a pickup in growth and inflation. If we leave, we get import-led inflation. So both good for UK index linkers against conventional gilts. We've certainly seen a pickup in inflation since the February lows as people got slightly more optimistic about some of the economic data coming through. Certainly financial markets have responded quite positively since February. So that leads us on to this constant debate of whether financials or energy should represent the value in portfolios that counterbalance that growth aspect of portfolios, and looking at the fundamental drivers of those two sectors. So for financials, it's the 10-year yield. For oils, it's obviously the oil price. Now, financials have sold off because of concerns over their exposure to oil company default, and they haven't rallied with the oil sector and the oil price. So we're looking at the sector and thinking it's probably has got some catch-up potential in it. This chart sort of confirms that feeling that we've seen the 10-year yield not rally at all, while we've seen other growth-sensitive asset classes such as the oil price and the equity market maintain a level or go higher. So we think there's some catch-up there. And a higher yield was obviously drive margins for financials, which would be good for their earnings. We've also seen, and probably most importantly, very encouraging trends in terms of shareholder returns in financials, and that is juxtaposition quite sharply against the concerns we've got over those energy dividends should the oil price stay low. Looking this week at some of our themes, we've got some very interesting data from the department stores in the US, and we're seeing a very sharp deterioration in these numbers. Macy's, for example, had its 7th consecutive top-line miss this week and a 5.2% decline in sales on the quarter. So we continue to believe that in this space, we're seeing a big shift in economic value to those brands that have the strength and can sell direct to consumers. So not only are you getting a sort of concentration or aggregation of consumer spend within those brands, you're also getting a margin expansion because they're cutting out these middlemen, the department stores. Equally, and that leads us on to online, because that's where most of these transactions are taking place. The online ad market, we've got the sort of quarterly results that have now come in, and that's been very helpful in reinforcing our view that the online ad spend is going to two places, Google and Facebook. We've talked about that before, but Google and Facebook drove 90% of the growth in the US online advertising sector this quarter, compared to 75% 2 years ago. So that is actually accelerating. Interesting to just look at the share prices of those two companies since they reported. Facebook's been very strong against the S&P. Alphabet has underperformed because we saw a degree of cyclicality in their numbers because they did much better in the holiday season last quarter. We felt that was an interesting trend that we need to keep an eye on. In terms of the week ahead, it's a revisit to some of the Killik UK names. So ICAP, which we find really interesting with the Tulip-Prebon merger and the potential for that to re-rate to platform stock type of multiple. We've got Vodafone, we've got Land Securities, obviously deeply involved with the Brexit. We've got Home Depot, we've got Marston's, again a very domestic consumer-facing stock. We've got National Grid on Thursday, and that's it from the Killik & Go stocks. So thanks for listening. Have a good weekend.